Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, now today let us revise chapter 2, which is risk management in CFA and AFM or SFM as it was called in the old syllabus. Now this chapter has good amount of theory, not many questions actually, 9 questions only. But it has these questions on VAR, and questions on VAR have come multiple times. So we will look at both the theoretical as well as practical aspects in this particular revision session. And first let me finish off theory, and I am pretty sure you have access to my theory compiler, which if you don't have access, please go and check the description of this video, you will get that. If you are a paid student, anyway you have access to it as part of the overall paid course. Now, risk management, let us get into the particular thing right away, and please note, out of these 9 times and out of these 9 questions, 6 questions have been asked in past exams. When I say past exam, I am referring to this syllabus which came out sometime in 2017 was applicable till November 23. So in that time, out of 9 questions, 6 questions have been asked. Now let us look at the first question. What are important types of risk faced by an organization? Very simple. This is super simple. You have strategic risk, financial risk, compliant risk, operational risk. Other risks fall into this. All other risks, strategic, financial, compliance and operational. These are the 4 risks into which everything else folds into. Strategic risk is what? A successful business needs a comprehensive, well thought out business plan. Strategic risk is one in which a company's strategy becomes less effective and it struggles to achieve its goal. So basically, company's current way of operating is not sufficient, its strategy is useless. I'm using the word useless by design, okay? And it could be due to existing environment changes, technological changes, new competitors, shift in customer preferences or increase in cost of raw materials. So you look at our, you look at classic example is Nokia, right? Nokia, what happened? Technology changed. Gone. The whole business went away for Nokia. Same thing with BlackBerry. I don't know how many of you are aware of BlackBerry. Then a new competitor entering in the market. So you have these new guys who are coming into the market with big money. Reliance Jio is a classic example. They forced out all these, Vodafone, Idea and all of that out of the telecom market. Shifts in customer preferences. Customers may want something very different now, because of which your strategy of, may not work. Increase in cost of raw materials. So steel industry is one where, which is constantly hit by this. Raw material price fluctuations, volatility, so on and so forth. So any of these factors like environment, technology, competitor, customer preference and raw materials, 5 of these can actually hit or can pose a risk, strategic risk. These are the 5 aspects which cause the strategic risk. Compliance risk. Every business needs to comply with rules and regulations. It could mean compliance of various regulations. Very simple, okay? Rules and regulations, depending on geography and industry, okay? Operational risk. This operational risk is one of the major things. It relates to internal risk. It also relates to failure on the part of the company to cope with day-to-day operational activities. Operational risk relates to people as well as process. Operational risk is both people as well as process. And then you have financial risk. Financial risk is basically changing financing conditions like liquidity, currency, interest rate, political and counterparty. Okay, so let me go into each one of them. Liquidity risk is basically you run out of money. That's all. That is liquidity risk. Broadly, it can be defined as inability of an organization to maintain its liabilities when they become due. That is the thing. This arises when organization is unable to generate cash flow if there is a mismatch. The type of risk is more prevalent in banking, where there is mismatch in maturities. Okay, so where you don't have enough money, that is liquidity. Currency. This risk affects organizations that have dealing in foreign exchange. So if you are a big importer and rupee depreciates, okay, then you're exposed to currency. Your basically cost of input raw materials goes up. If you're an exporter and currency appreciates, so think of yourself as Infosys, rupee moves from 80 to 60, your revenue falls. Okay, the risk can be affected by cash flow adversely or favorably. It can have an impact on cost of production, sale value and value of assets and liabilities. So I spoke about importer and exporter. I didn't talk about assets and liabilities value. So let's say you have an investment outside India and it's an investment that you've made. So its value is dependent on current exchange rate. Let's say exchange rate changes substantially and the value gets changed. No? So let's say rupees 80, you have $100 million investment made somewhere outside in India in some US. Suddenly rupee moves from 80 to 50. The value of your investment outside India changes, right? Interest rate risk. Interest rate risk are of two types, fixed and floating. We'll learn about this in a chapter called interest rate risk. The floating rate risk is interest rate is linked to a specific benchmark. When rates are rising, floating rate borrowing is expensive. So floating rate means, let's say the RBI repo has something called as a repo rate. So your housing loan is linked to repo rate. If the repo rate keeps going up, your housing loan rate also keeps going up. So the risk when interest rates go up, your cost of your borrowing also goes up. That is called as a floating rate risk. And what is fixed rate risk? Exactly opposite. That is, you agree to borrow for your housing loan at 10%, but the interest rate and when the market, when repo rate was some number, suddenly the repo rate came down, but your interest rate is fixed because you have entered into a fixed rate loan. So you are not getting benefited from reducing interest rates. That is a fixed interest rate risk. Then you have something called political risk. These arise due to political situation, change in government, so on and so forth. Confiscation or destruction of overseas properties, rationing or remittance to home country, restriction on conversion of local currency, restriction on borrowings, invalidation of patents, price controls on products. So these are related to financial. This is what the main heading is financial risk. But these political risks manifest. So, or rather these political risks result in financial implication. Okay, eventually you can say every kind of risk results in financial implication. No, but here in this specific case, you use finance related activities to affect somebody politically, or there is a very close connection. So let's say suddenly, in this case, there is a restriction on borrowings, or there is a restriction on currency, or there is a restriction on repatriation. These are all both linked to finance as well as linked to politics. So hence this political risk comes under this financial risk. And finally, you have counterparty risk, which basically is credit risk. You have lent money to somebody, that money is not coming back. Credit risk. This risk occurs due to non-honoring of obligations by a counterparty, which can be failure to deliver goods for the payment already made, or vice versa, or repayments of borrowing and interest. Okay, so these are the various types of risk. Strategic, financial, compliance, operational. Operation is related to operation. Strategic is because you have not changed due to technology, environment, customer preferences, a new competitor, or increasing cost of raw materials. And then you come to finance. Finance, which is basically about your currency, liquidity, then you have political, and then you have your interest rate, and finally you also have your credit risk, which is your counterparty risk. What are indicators of counterparty risk? How can it be managed? Also a very important question. How do you manage what is the indicator? That's the first question. How do you manage it is the second question. So indicators are basically red flags. How do you know that some party is a dangerous fellow? How do you know? Let's say you have a friend. How do you know that your friend, if you lend money to your friend, money will not come back? How do you know? How do you decide? That is basically, think of it very simplistically. Okay. Failure to obtain necessary resources to complete the project or transaction undertaken. So basically, he is borrowing from everybody to buy a car. So do you seriously think he does not have, so if he does not have money to buy a car on his own, then I'm pretty sure he will take the car and run away. Right, so there's no point lending to somebody like that. Past history of insolvency, your friend has cheated you multiple times, even then you are willing to lend, then it is your stupidity. Any regulatory restrictions from the government says that, this kind of businesses cannot do something. Then in that case, entire business is dependent on the government. So there is a very high chance of risk. Hostile action of foreign government. So let's say you are based somewhere very close to the border, or you are based in some foreign country which is not your friend. Let down by third party, where there are multiple aspects which are linked to third parties, and the dependency on third parties is very, very high. So in such cases, you may have, which are basically red flags of counterparty risk. And how do you manage all of this? You do proper due diligence. Do not overcome it. Define limits. Review the limits. In case of any default, take very, very quick action and use third party guarantees, insurance, and other instruments. So basically, you are very careful. How are you careful? You limit your exposure, monitor the exposure, take very quick action in case of any defaults, and take third party sureties guarantees. This is one aspect. Do not give too much money, basically do not overcome it, and do lot of due diligence. So these are the hints, and these are the measures to manage counterparty risk. Next, what are indicators of political risk? How can it be managed? Indicators of political risk are nationalization, price fixation, local joint ventures, restriction on currency conversion. So basically, when you have these kind of features in an economy or in a country, then basically the political risk situation is very high. How do you mitigate the risk? You enter into joint ventures so that you are not fully, you have a party based in local country who will manage the local government, study the foreign investments, get local financing. So borrow from local banks to invest in that particular country. Get in multilateral agencies like World Bank. What are multilateral agencies? World Bank, IMF, BRICS Bank, bunch of other banks. Prior negotiation. So please go and talk to the government or wherever there are cases where you can speak to people, go and talk. Check for political risk indicators, understand local politics, local embassies, go and talk to them, local embassies, take their consulates and embassies, go and talk to them and understand the macroeconomic situation. These are the ways in which you can mitigate the political risk. What are indicators of interest rate risk? It is all, interest rate risk is everything about economics and finance only. You have macroeconomic risk, macroeconomic data. You have to constantly check macroeconomic data. Things like demonetization, inflation, RBI policy, financial position and inflation. And also of course industrial output, which is basically how fast is the economy growing. Basically this is some kind of GDP growth or something like that. Okay. So these are the indicators of interest rate risk. If things over here are not correct, it means that the interest rates will change. Interest rates will change, affecting you, maybe they could affect you adversely. Then, what are the parameters to identify currency risk? So, how do you identify currency risk? First is government action, nominal interest rate, inflation rate, calamities, wars, change in government. So, basically, if interest rate, currency risk, what happens? Either the currency is depreciating or appreciating. How will you identify aspects that cause currency risk? Government action. The government of any action has visual impact. For example, UK decision to move away from European Union, Brexit brought the pound to its lowest level. So when Brexit happened, pound depreciated. Nominal interest rate. So if interest rate parity, that particular theory has to hold good, currency should depreciate. So if interest rates are very, very high in your country, let's take example of India and US. India-US, let's say exchange rate is 80 or 85. Okay. And interest rate, let's say in India is some 15% and US is 2%. That means Indian rupee has to further depreciate. So you have to constantly monitor the interest rate differential or inflation differentials to figure out. So next part is actually inflation rate. So you have to constantly monitor interest rate and inflation differentials to ensure that if the currency is depreciating, you take the mitigative action right away. Then natural calamities. If there is any natural calamities, obviously the economy may suffer a hit, and because of which you may have a currency, the GDP may go down or something may happen because of which currency may be hit. Then you may have wars or coups or rebellions which will impact a currency. And change in government. If the government has a very different attitude, government is positive, strong, pro markets and all that, probably currency may appreciate. If the government is very casual, don't know what is happening, government is full of communists or things like that, people who believe in welfare state fully, who believe in socialism, there is high fiscal deficit, then currency will depreciate. Okay, so these are the parameters to identify currency risk. Now comes the practical and more interesting aspect of this chapter, VAR, VAR, VAR. Okay, what is VAR? Explain. VAR is a measure of risk in investment. Measurement of risk is likelihood of something happening. VAR is maximum possible loss at a specific probability. This is the key word. So when you look at subjects like auditing or where you have to use specific words, right? You will say, let's say auditor issues a qualified opinion. You won't call it auditor has issued a bad opinion, auditor has issued a negative opinion. You don't use words like that. Use specific words which are like auditor has issued a qualified opinion or modified opinion or an adverse opinion. You use specific words like that. You have to use specific words when you are describing VAR. VAR is maximum possible loss at a specific probability. Only when you use a sentence like this will you get marks in the exam. Okay. Given the normal market conditions in a set of periods, say 1 day, it estimates how much an investment might lose. This investment can be a portfolio, capital investment or foreign exchange. It's a type of statistical tool based on concepts of standard deviation and normal distribution, and VAR can be applied for different time horizons, say 1 week, 1 day or 1 month. So basically, I will take you through what exactly VAR is. It is maximum loss that you can incur. It can be used for portfolios, it can be used for capital investment or foreign exchange. It uses statistical tools like standard deviation, normal distribution, and it can be applied for different time horizons. It can be for 1 day, 2 day, 4 days, 6 days, 300 days anyway. Okay, this is VAR. Now, let me explain this slightly more intuitively. Let me get slightly deeper. So, how do you compute VAR? This is from the book that we have printed and given to the students. This is the book that we give along with course purchase. Okay. VAR is basically, this is the formula. What is the formula? I am writing it for your visibility. standard deviation of a portfolio or a particular security into, and the standard deviation, please note, is in percentage form, or if it is not in percentage, it is in decimal point, 0.00 something, okay, into value of the portfolio into cumulative Z score, okay, into, if you have to compute it for 10 days, you do under root time. Time is in days, so 10, 12, and assuming this standard deviation is also daily standard deviation. If this is daily standard deviation, here the time is also days. If the standard deviation is monthly, here the time will also be month. Please note, this standard deviation and this time, both of them are linked, both of them are for same unit of time. Value of the portfolio is very simple. Cumulative Z score. I will come to you what is cumulative Z score. But before we come there, first let us understand what is standard deviation. Let us go back what is standard deviation. So this is something you would have studied in your class 10, 11, 12, where you would have understood about mean, median, mode. Just a recap, very brief recap. What is mean? Mean is simply the sum of sigma x by n, basically sum of all values divided by n. What is standard deviation? Standard deviation is square root of variance. It is sigma x minus x bar whole square by n. This is variance. So standard deviation is under root of this. Standard deviation is under root of this. Right. Now, what does standard deviation measure? It basically measures how much further away from the mean each value is, ignoring the sign, because it is under root. See, if it is square, once you square something, the sign is lost. X minus x bar, once you have squared it, the sign is lost. And then when you are taking a root of it, you are basically trying to identify what is the value of all the variances, or how far away from the mean, or how far is each value away from the mean. Basically, that is what is standard deviation. So, in risk management, in this advanced financial management subject or SFM subject, and standard deviation and variance depict risk. VAR is not risk. VAR is maximum possible loss. What is the value that is at risk? What are you measuring when you're talking about risk? When you're talking about risk, you're measuring what is the possibility of a loss, right? So value that is at risk means what is the potential highest possible loss value. Okay, so that is what you're computing. This is variance. So this is where you have got. Now variance, this variance is, when you look at variance, here x minus x bar, what you have done, x can be daily values, or x can be monthly values, or x can be yearly values. When you compute x based on daily values, you get daily variance. When you compute on monthly values, you get monthly variance, and you compute on yearly value, you get yearly variance. You have to be very, very clear. So this variance number is computed based on the units of time for which you take this value of x. If x is stock prices every day, then it is daily variance, daily standard deviation. X is stock price end of every month. Okay, then you consider it that particular number of months. Okay, like that, it is monthly variance. Now, what is covariance? Why do we need to know about covariance? Because there is one particular thing that you have to understand, which you will learn this particular concept in portfolio management. In portfolio management, for a single security, variance is sigma x minus x bar whole square by n. Okay, but for portfolio of two securities, the portfolio variance is sigma 1 w1 whole square plus sigma 2 w2 whole square plus 2 sigma 1 sigma 2 w1 w2 and correlation. Correlation can be R, or you can call it as P also. Rho, it's called rho. It is not P, it's called rho. Okay, and sigma 1, sigma 2 rho is covariance. So you can write this particular equation as 2 W1 W2 covariance 1, 2. So portfolio variance is this formula, sigma 1 W1 whole square plus sigma 2 W2 whole square plus 2 sigma 1 sigma 2 W1 W2 into correlation, or correlation into sigma 1 sigma 2 is covariance. So the last part becomes 2 covariance into W1, W2. So this looks like A plus B whole square formula exactly. But this is variance of a portfolio of 2 securities. Why am I doing all of this? Because you may have to compute VAR of a portfolio also. VAR can be computed for a portfolio also. At that point of time, you have to compute portfolio variance and portfolio standard deviation and then come back and use this particular formula. Where is that formula that we discussed? Here. Variance or standard deviation into value of the portfolio into cumulative Z score. So Z score I will come. First I am talking about variance or standard deviation. Okay. So, this is where that formula is. This is what that formula is, covariance. Standard deviation is equal to W1 sigma 1 W whole square plus W2 sigma 2 whole square plus W1 W2 sigma 1 sigma 2 and correlation. And covariance is, the value is this. If covariance value is available, direct, instead of using correlation, you multiply with covariance. Now, after having understood this, if you want to find out covariance, the covariance also there is a formula, sigma x minus x bar into y minus y bar by n. It is very similar to variance, but it is between 2 different securities. How are they moving together? What is variance? Variance is, or standard deviation. Let us compute what is standard deviation. Standard deviation is how much is each value varying away from, or how much is each value away from the mean. Variance is square of standard deviation. Covariance is how are 2 values varying from each other from their mean together. So x minus x bar and y minus y bar. Y bar basically means y mean, x means x mean. So there is a set of values of HDFC Bank and ICICI Bank. Both of them are moving, the stock price at the end of day every day. How are they moving together? So you take average of all ICICI, average of all HDFC, subtract x, every value of HDFC minus the mean of HDFC, every value of ICICI minus mean of ICICI, multiply them both. Do that for every value. So sigma x minus x bar and y minus y bar by n, this is covariance formula. Okay. Now coming to this whole thing about normal curve or a bell curve. So the logic in normal curve or bell curve is large amounts of data typically form a bell curve. What is this whole bell curve? Bell curve is, they all fit a pattern. And what is this pattern? This pattern is roughly most of the data. If you were to plot this data, you have a mean and you find out the standard deviation for all the data points. Roughly 68.26, what is this percentage? Yeah, 68.26% of the data will lie. So it basically is this whole thing, everything in green. 68.26% of the data will lie within 1 standard deviation either side. And within 2 standard deviations, you will have 95% of the data. And within 3 standard deviations, you will have roughly 99.73% of the data on both sides put together, right? So, most of the data with respect to financial markets follows this particular normal distribution. When you standardize by taking a standard values, that is you take mean as 0, then you call it as a standard normal distribution. When you take mean for what it is, then you call it as a normal distribution. So this particular thing is called as a bell curve. It is a continuous distribution, and usually large amounts of data follow normal distribution, and it is a probability distribution that is symmetric about the mean. The data that is nearer to the mean is more frequently likely to occur. Now, what does this all mean with respect to our stock markets? What we are basically saying is, if you compute daily returns in the stock market, every day probably you will get, on an average, the average of all the daily returns will, let us say, is 0.2%. So most of the data, for if you take, let's say you compute the data for last 10 years. Out of 10 years means how many data points each year? 255 data points. So 255 into 10 is roughly about, why 255? 255 trading days. How 255 trading days? There are 52 weeks and you have 12 holidays and all of that. So each week 5 days. So that's how 250 days. 250 into 10, 2500. Out of 2500, for 68%, the return will be 0.2% plus or minus standard deviation. I am assuming 0.2 is the mean return. Standard deviation can be anything. You can arrive at that number based on what the historical returns are. But you will see that most of the data lies here. Then if you want to see more data, you want to see 95% of the data, 252 into 95.46%. 240 days. So for 240 days of data will lie within these boundaries of 2 standard deviation. So daily return, and I am not talking about the values of the stock, I am talking about the change in the value of the stock, right? So that is why you are able to plot all the returns in this particular small graph. Hence, using this particular bell curve, you can arrive at what is the maximum variation that can happen based on 95% confidence, 99% confidence. How can you arrive at confidence? Because you know that 95% of the time the data lies here, no? So like that you work backwards, and then you can make statements like maximum loss on this particular portfolio can be this much. Okay, so that is what you can do. Now coming back again, key points what I wish to highlight in this, which is you take something called as cumulative probability. What is this cumulative probability? So if you draw a bell curve like this, you have 0.2% is the daily return assuming. Some days you get 0.3, 0.4, 0.5 and all. Some days you get minus 0.1, minus 0.2, minus 0.3, minus 0.5 and all. So these are loss making. These are profit making. So when you're talking about loss, you should ignore all of this side, no? You should ignore this completely, this side which is, when you're talking about losses, you should consider only this. This entire side should be ignored, which is making profits. So when I told you earlier that 95% of the data fits in, I am assuming 95% starting from middle and going on both sides. However, if I have to look at only one side, then how many standard deviations should I go for me to fit, let's say 90% of the data, 95% of the data, so on and so forth. So what basically we are saying is, read this. A cumulative z-score for a set of data provides a number of standard deviations away from the mean of a particular confidence level. It is when it is taken from one side of the normal curve. So when you start from here, assume that you have covered till the end. When you start from here, till what point you have to come, and this point is how many standard deviations away from the mean, such that you cover this area covers 90% or 95% or 99%. That is given by these numbers, cumulative probability, which is if you have to cover 90%, you have to move 1.28 standard deviations away. If you have to cover 95%, you have to move 1.65. If you have to cover 99%, you have to move 2.33 standard deviations away from the mean. This is when you take one side. When you consider both the sides, these numbers changed. This is one side. When you take two sides, these numbers change. How will they change? 1.65, 1.96 and 2.576 or 58. You can take 58. Okay. So when you take two sides, when you're taking both the sides, if you cover 1.65 standard deviations from the center on either side, so it is like this, you cover 1.65 here, 1.65 here, on both sides standard deviation, you are covering roughly 90% of the area, which is what exactly this is. Between 2 and 1, you cover 1.65, you have covered 90%. If you have to cover 99% or 95%, what is it? 95, no, next one. You have to go to 1.96 and 99 is 2.5. However, if it is one side, then it is 1.28, 1.65, 2.33. Why am I telling all of this? How is this relevant for the exam? In the exam, typically they will give you this. Sometimes, in fact, I think in one of the questions also they gave. Yeah, see, this was a question in one of the exams. Standard normal probabilities, cumulative standard normal probability. I told you when you standardize everything to the mean, this is called standard normal probability. And Z value they have given here 2.33. 2.33 is basically this. You cover 99.01% of the area. Okay, 2.32 is 99.98. It should be 98.98 and not 99. 98.98 and 2.33 is 99.01. So you basically cover 99% of the area for one-sided when you look at one-sided, but when you take 2.33 standard deviations away from the mean on one side. This is what you have to know. Now coming back. Now you have understood multiple things. You have understood what all? Mean, standard deviation, variance, covariance, correlation, portfolio variance or portfolio standard deviation. You have understood VAR. You have understood normal distribution. You have understood standard normal distribution. Then you have understood cumulative area. So many concepts. Okay. What are applications of VAR? This is super simple. Applications of VAR are, it is used to measure maximum possible loss of any portfolio or a trading session. It is used as a benchmark for performance measurement. It is used to fix limits. It enables management to decide a trading strategy, used as a tool for asset liability management in banks. So basically, when you have maximum possible loss that you can take, that you define or decide based on historical data, you say, okay, this is the maximum loss I can take. So I will now distribute this loss among 5 traders, and each trader can take maximum of so much hit. So I will set trading limits. I will set trading limits using this VAR. Then I will use this as performance benchmark for operation. So if anybody gets more loss than this, then they are waste. I am using a very casual language. Don't write that in exam. If somebody makes more loss than what is VAR, then they are exceptionally bad. Then fixed limits for individuals, I already discussed. Enable management to decide trading strategies. So you can decide strategies based on, each strategy will expose you to how much of VAR. Right, then it is used as tool for ALM in banks. So banks also, when they have assets and liabilities which are mismatched, how much is the total loss that is potentially possible, you evaluate and then you take trade decisions. Okay, so these are applications of VAR. This is also very, very important question. Next, what are characteristics of VAR? This is also important question. VAR, it uses the following: risk as measured by standard deviation, it uses statistical methods, uses normal distribution, uses Z-score. That is how many standard deviations away from mean at a specific confidence interval. It uses the concept of confidence level or probability. VAR is based on historical data. It's an approximate method based on normal distribution, computes maximum possible loss at a given level and can be done for various time periods, and helps in setting risk limits. So these 2 questions are super important. Super important. Coming to the last question, how do various stakeholders view risk? So this is a slightly interesting question. This has also been asked in the exam in the past. How do equity holders, how does the company, how does the government, and equity and debt also. Okay, equity and debt, company and government. See, equity and debt have some similar views, some divergent views. For an equity holder, too much of debt means that the money will go away, you'll keep on servicing debt, nothing will be left for the equity holders. Also at the same time, debt holder is also wary that if there is too much of debt, they are only taking all the risk. So they are also wary of the higher risk, right? So major stakeholders of business are equity shareholders, and they view excessive financial gearing, that is higher debt in capital structure, as a risk. So in the event of winding up, all the money will go away only to the debt holders, and they will not get anything. They become uncomfortable if there is too much debt. Same way, debt holders also believe that debt to equity ratio should be optimum, as higher debt equity ratio can pose a risk. How does a company view the risk management? From company point of view, company borrows excessively. So here, these are basically views financial risk. Okay. If a company borrows excessively or lends to someone who defaults and can be forced into liquidation, in order to mitigate such risk, it should evaluate its structure, evaluate risk, set up a risk management system, measure the risk and quantify risk. From a company perspective, it is not necessarily only financial. Okay. From a company perspective, it is not necessarily only financial. You have to evaluate the structure, evaluate the risk, set up a system, you have to measure the risk and quantify the risk. Government monitors risk keenly, as they have economy-wide impact and financial implications. Failure of banks like Lehman Brothers or downgrading of financial institution can lead to spread of distrust in society. Potential labor disturbances affecting company production, overall macro environment. So risks from a government perspective affect the people, affect the company, affect the tax revenues, affect the overall macro environment. So these are important questions in this particular chapter. Now let us go and look at some questions which will help you understand. I will take you through questions. There are hardly 4 or 5 questions in this chapter. We'll go through all the questions so that this chapter's revision is fully done. Okay, so let us look at this first question. There are hardly 5 questions in the chapter, so I'll cover all the questions. There's nothing much. Neil holds 1 crore shares whose market price standard deviation is 2% per day. So please note the word per day. Assume there are 252 days. Determine the maximum loss level over the period of 1 trading day and 10 trading days at 99% confidence level. Assuming share prices are normally distributed, it is not prices, it is return should be normally distributed, and 99% level for equivalent Z-score from the normal table for cumulative area is 2.33. So they have given you the 2.33. So shares held rupees 1 crore. Per day is 2%, which is standard deviation. Z-score is 2.33. So loss over 1 day is portfolio into standard deviation percentage into your Z-score into 1 day, right? So what have we done? 1 crore into 2.33 into 2% is 4,66,000. Okay, 1 or root of 1 both are same. Whereas if you do it over 10 days, what you'll do is 4,66,000, which is basically same value what you have computed, you'll multiply with root of 10, which will give you root 10 is whatever number it is, you multiply with root 10, you'll get 14,73,621. So basically the logic that you have to understand here is, if you have a normal curve like this, and assuming losses are on this side, the probability on that you will make a maximum loss. What is VAR? VAR is maximum possible loss over a period of time. So 99% of the time, okay, they have said 99% level 9 of the time, 99% of the time. If you have to compute what is the maximum loss that you will make, it will be only this much in single day. Whereas same thing you put 99% of the time, what is the maximum loss you will make over a 10-day period is this. So which you root under root of 10. You do under root of 10. So over a 10-day period, you have to find out maximum loss. This is a slightly bigger area. Let me draw it better here. My drawing is bad. So maximum possible loss over a 1 day is this. Whereas for over 10 days, this value increases. It increases to, even this gets added, no? Because maximum possible loss, you may have 1 day you may have one loss, second day you may have other loss, third day you may have other loss. Cumulatively, what is the overall loss over a 10-day period? What is the cumulative loss? It will be both these put together, which is why you compute, you take extra area under the normal curve. Okay, next coming to the second question. Investment in following is portfolio of Mr. J. Investment in ABC is 200 lakhs. Investment in XYZ is 200 lakhs, 200 lakhs, 200 lakhs. So basically 50-50%. Daily standard deviation of both the shares is 1%. Coefficient correlation between both the shares is 0.3. Determine the 10-day 99% VAR for Mr. J's portfolio given Z score for normal distribution 99% confidence level is 2.33. Show your calculations up to 4 decimals. What are we doing here? First we have 200, 200, 400, which is 50%, 50%. Standard deviation is 1%, 1%. So you can do this in two ways. So I've actually solved it in two ways. First way is you can do for values. Second way is you can do for weights. Okay, so here I have computed the standard deviation of 1%. 1% of 200 lakhs is 2 lakhs. So you can do this, compute the portfolio variance for 2 lakhs as standard deviation, or you can compute the portfolio variance as 50% of the weight. Okay, and then finally multiply with the required data. Here you are multiplying with the portfolio value of 400. So you can do absolute values and compute the standard deviation of the portfolio, or you can compute use weights and compute the standard deviation of the portfolio, multiply with the value of the portfolio 400 to arrive at the standard deviation of the portfolio. So what have you done here? I will not use both methods, I will use this one of them. So in this particular question, W1 sigma 1 is equal to 2, which is this 2. W2 sigma 2 is also equal to 2, which is this 2. So in this particular form, in this particular formula, this one is 2 square, this one is another 2 square, 2 W1 W2, 2 W1 W2 sigma 1 sigma 2 and correlation, right. W1 and sigma 1 are 2, W2 and sigma 2 are another 2, so there are 3 2's. And you have correlation. Correlation value is how much? 0.3, 0.3. So you are multiplying 2 square plus 2 square plus 2 into 2 into 2 into 2 into 0.3. So what you will get is 4 plus 4 is 8, 2 into 2 into 2 into 0.3, 2.4, 8 plus 2.4 is 10.4. So there is a 2 into 2 into 2, 3 times 2 into 0.3, you will get 10.4. If you do it on the weights basis, what is standard deviation? 1%. So it is you can take it directly 0.01, or you take it 1 and then subsequently add the percentage. So you do 1 into 50 plus 1 into 50 plus 2 into 50 into 1 into 50 into 1 into 0.3. So you arrive at a value of 0.301. Okay, and square root of 0.301 is 0.2081. Okay, so 0.2081. So 0.2081 into 400 will give you 3.2249, which is the standard deviation of the portfolio, or you take the value here 10.4 under root, you will get 3.2249. Both ways you will get the same value, which is portfolio standard deviation. So what do you have? You have portfolio value is 400 and portfolio standard deviation. Please don't take again portfolio standard deviation as 3.2249 lakhs, because that is value in lakhs. I told you portfolio standard deviation has to be in percentage. What is the percentage value? We computed here, which is 0.0081. 0.0081. So you have to multiply with 0.0081 into 2.33 into root 10. So under root 10 first, let me first find out under root 10, 3.1623. So 3.1623 is under root 10. So 3.1623 into 2.33 into 3.2249, you will get 23.76, 23.7616. That is the value that you will get here. Okay. Next question. This is where you use that formula of portfolio standard deviation, portfolio variance. Suppose you hold worth 2 crore shares of X Limited whose market price standard deviation is 2% per day, assuming 250 days, determine the maximum loss over a period of 1 day and 10 days. Very, very simple. 200 standard deviation is 2%, which is 0.02. Confidence interval is 99%, so the Z value is 2.33. So for 1 day VAR is 200 into 2% into 2.33, which is 9.32. If you have to compute it for 10 days, you multiply it with under root 10, you get 29.47. Very simple, there is nothing. This is a question that I have asked at least a couple of times, or a variation of this question has been asked a couple of times in the exam. On Tuesday morning, before opening of the capital market, investor while going through his bank observed that amount of 7 lakhs is lying in his account. This is available from Tuesday till Friday. The bank requires a minimum balance of 1000 at all times. The investor desires to make maximum possible investment where the VAR should not exceed the balance. So the balance that he has, what is the balance that he has? He has balance of roughly about 7 lakhs. 7 lakhs minus minimum balance is 1000. So 6 lakhs 99,000. So the VAR should be 6 lakhs 99,000. The standard deviation of market price of security is 1.5% per day and the required confidence level is 99%. So given these standard normal probabilities, you are required to determine the maximum possible investment. So it is very simple. 7 lakhs minus 1000 is 6 lakhs 99. That is the VAR. So VAR is equal to portfolio into standard deviation portfolio into Z score into root of days, provided this portfolio standard deviation and this time are of same units. Okay, so we have to find out now the portfolio value. We've been given the VAR. VAR is 6.99 lakhs is equal to P into standard deviation of the portfolio on a daily basis is 1.5% into 2.33, which is Z value, into for how many days? 4 days into root 2 into root 4 basically is 2, right? So you work on this 6.99 divided by 2.33, you basically directly get 6.99 divided by 2.33, you will get 3 lakhs, right? 3 lakhs divided by 0.015 basically is 1.5%, you will get 200 lakhs. 200 lakhs divided by 2, you basically get 1 crore. So you basically get 1 crore. So this is the case when you make an investment for 4 days. If you make an investment for 1 day, you don't divide it by 2. So you will have to multiply this back by 2. So you will make an investment of 2 crores. That's all. Very, very simple. Super simple. They have asked a variation of this question, but that also can be very easily solved. Consider portfolio of P and Q. P is 5 crores, Q is 12 crores. So we cannot do it on weights because the weights are will be in percentage points, 5 by 17, 12 by 17. Okay. The daily standard deviation of P is 0.5 and Q is 0.2. The correlation coefficient is 0.3. You are required to determine 1 week VAR. 1 week means 7 days at 99% for the portfolio. Assuming week is 5 days, not 7 days. They themselves said week is 5 days. So P limited 5 crores, Q limited 12 crores. Standard deviation is 0.5% and 0.2%. You multiply these two, you get weights. Or you can do it manually. This is the weight way of doing 29.41 and 70.59. I am not comfortable with that. I would rather do it normally, which is basically you multiply the value of arrive at the standard deviation in rupee terms instead of arriving at it in the terms of percentage. So 5 into 0.5%, 12 into 0.2%. 5 into 0.5 is 0.025 crores and 12 into 0.2 is 0.024 crores. So you have to be very careful with decimals here. Okay. So 0.25 square, because sigma 1, W1 both are accounted for in this already. Okay. 0.25 square plus 0.024 square plus 2 into 0.025 into 0.024 into 0.3. We have discussed why we are multiplying with correlation also. You get a value which is basically 0.0016. This is directly the value. So this value basically is portfolio variance. So you have to take the standard deviation, you will get 0.0395. So this 0.395 is already multiplied with 17 crore. So you need not multiply again. So 0.0395 into 1 crore will give you a value which is basically the portfolio standard deviation in rupee terms. So this already is accounted for this part and this part. All we need to do is now multiply it with 2.33 and time, which is 5. So you basically take this number 3,95,094, multiply it with root 5, multiply it with 2.33, you get 20 lakhs as the VAR. So this is a very simple problem. There is nothing complicated. If you can solve it on your own and you will be able to understand. These are very simple problems. I have given already all the solutions for this as part of the compiler. So this concludes the revision for chapter 2. Very simple chapter, nothing complicated. However, please remember this particular chapter, risk management, has 8 questions that have been asked historically. Even though there are how many questions in this particular chapter? This particular chapter has only 9 questions. 6 questions have been asked in previous exam, okay, and they have been asked 8 times. Same 6 questions have been asked 8 times. So 1 question has been asked more than once. Okay, so please be aware, this is the number of times questions have been asked. It's a very important theory chapter, and I explained to you the whole VAR concept. VAR is super simple, and there is no change in this particular risk management chapter from SFM old syllabus to AFM new syllabus. Everything is same, ditto same, there is no change. Okay, so this concludes the revision of this particular chapter, chapter number 2.